Welcome to FT Markets. Two of the world's largest central banks are at the crossroads. Having embarked on their forward guidance revolution, the Bank of England and the US Federal Reserve are slowly changing tack. Last week, both Janet Yellen and Mark Carney stopped linking the future path of interest rates to the unemployment rate alone, while still committing to keeping monetary policy loose in the near future. How useful, if at all, was forward guidance? What should the US and the UK fear from the decision by their central banks to leave aside their flagship policy? Discussing it here with me is Andrew Goldberg, Global Market Strategist at JPMorgan Asset Management. Thanks for being with us, Andrew. And we are looking then at the question facing Mark Carney and Janet Yellen here, for whom the good economic news which has come out from the economy in the last few months has actually maybe been bad news. And so we can have a look at the first chart which you brought with you today. And that's the US and the UK unemployment rate since 2004 to 2014. And we can see that after really shooting up during the crisis, the unemployment rate over the last few months has been coming down quite dramatically, really. And this poses question for central bankers.
It sure does. As you stated before, these central bankers tied expectations of forward-looking interest rates to the unemployment rate. And those unemployment rates have fallen, I would say, much faster than they had anticipated. I think there's an interesting lesson in this, which isn't to say necessarily that forward guidance is bad, but it is to say that tying expectations for interest rates to any one economic metric is inherently risky. There are a number of factors that impact the direction of the unemployment rate. And what you've seen most recently is that they're backing away from that one particular measure to broaden their forward guidance.
Right, so there are some dangers there, but one important question which I think a lot of policymakers have in mind is, was forward guidance any useful or not? And we can take a look at your second chart. Now, we can see here the UK yield curve, so one of the two relevant charts here. And we can see how it's moved from 1 year ago, so where it stood 1 year ago, that's the blue line, and where it stands now which is the red line. So was forward guidance any useful in the UK case?
I think it was, and I think that it's not necessarily that forward guidance is dead. I just think that the approach to forward guidance needs to adjust. And I almost equate it to giving somebody directions to a destination that's far away. At first, any direction that I might give you, for example, we'll start off general. For example, head westward. As you get closer to the destination, the directions will become more specific and more nuanced. And that's kind of where we are today. So forward guidance has been useful in the sense that it has set an expectation that the central bank in England wants to keep interest rates low for a while. That message has been reflected in the short-term interest rates on the yield curve, which really haven't moved very much. So you and I can debate the credibility of the Bank of England, but markets seem to believe that there is no risk of higher interest rates in the near future.
Right, but now looking forward, what do the markets expect after this slight change of mind by the central banks? And we can take a look at your third graph, which is looking at rate expectations in the UK and in the US. What do we learn from this?
Well, I think what we learned from this is that the markets still remain convinced that, at least in the short run, and as you look at this, it looks like at least through 2014, interest rates in England aren't going to go above 1%. So again, interest rate expectations remain very well anchored. Today's an interesting time to tape this report because, as you know, the inflation number came out and it was weaker yet again. This is the first time, I believe, that the inflation figure has been below 2% since 2009. And so that actually gives the Bank of England and Mark Carney some room and some scope, as he said, to keep interest rates low for long. One argument that I'm not particularly compelled by or not completely sure of is that when the Bank of England and Mark Carney used the amount of slack in the economy as a guidepost, that may be another mistake in the making. Measuring slack in an economy is notoriously difficult to do. It can be very vague. I think inflation's the better way to approach this, and right now there doesn't seem to be much inflation pressure.
Well, thank you very much for being with us, Andrew. So for now, maybe not that much to worry about from the step back from forward guidance, but whether markets will remain so well behaved in the future, well, that's anyone's guess.